The MPC reviewed current and evolving macroeconomic and financial conditions and decided to keep the policy rate unchanged at 6%.
I think as far as government is concerned, we've had a very consistent position for some time now that we think as far as real interest rates are concerned, they should certainly be competitive.
I'm a bit disappointed because, I'm a businessman, I'm not an economist, but of course they have taken a thoughtful decision. But if you look at the real interest rate, if I look at inflation and look at the real interest rate in India, is quite high.
Definitely disappointed with the industry because we're expecting huge cut, at least 1% cut in the interest rate.
People would have been happy in industry if rate was down by 50 basic points.
Hello and welcome to this special coverage of the Monetary Policy Committee's rate decision. Amid clamour from industry and nudges from the government, the Monetary Policy Committee has decided to stay the course, not cut key policy rates. I'll venture further, it's actually chosen to be hawkish. Well, here are the key highlights from the monetary policy. 1, the repo rate has been left unchanged. 5 members of the MPC voted status quo. Only 1 member, Ravindra Dholakia, voted for a 25 basis point rate cut. 2, hopes of future cuts have been rendered nil, with the Reserve Bank raising inflation forecast for the second half to 4.2 to 4.6 from the earlier 3.5 to 4.5. Also, the Monetary Policy Report expects the FY19 inflation to average above 4.5, so rate cut hopes look like nil. Third, the only big cut that came was handed to the central bank's growth projection. That estimate has been cut to 6.7% from the earlier 7.3%. And fourth, the Reserve Bank, in a major institutional change, hopes to push banks from getting their lending rates based on their own costs to setting lending rates pegged to market benchmarks, like, say, the MIBOR or the 10-year bond. Well, those are the key takeaways as I see it, but let's have the best and the brightest from industry to discuss it. To analyze the Reserve Bank's comments, to parse them threadbare, I am now joined by Sajid Chinoy, the chief economist from JP Morgan, Manish Madhawan of HSBC India, and Sunil Mehta, the managing director of Punjab National Bank. A. Prasanna of ICICI Securities Primary Dealership Unit is also joining us in a bit. Gentlemen, thank you very much for joining me. Manish, you go first. This is a hawkish policy.
Yeah, Latha, it is definitely neutral to hawkish policy against all expectations. And, there was a clamour, as you said, for a large rate cut, but RBI didn't oblige at all.
How do you see the direction of interest rates, or rather of bond yields from here on? Today, the market has given its verdict, 6.4 before the policy was announced, 6.7 afterwards. Where do we go from here? What's the range?
I think before alluding to what is going to happen to bonds, I think there are certain important factors which the MPC has laid out. And the key takeaways are that they have raised, as you said, the inflationary projections for the next half, which is pretty important for us. And in the commentary which ensued after that also, he mentioned that in the scenario of rising inflation, they need to be much more concerned about that part rather than growth. The other side is the growth projections have been, they have been brought down, but with the caveat that whether these factors are transient or permanent, it is yet to be seen. Beyond that, I think there are so many small things which, from a bond market perspective, are very important. RBI has done OMOs in this year worth 70,000 crores, which is more than $10 billion, which completely negates the FPI buying of around $14 billion in terms of the bonds. Yeah. So, that kind of a thing. Liquidity we have seen to be, the surplus liquidity has been reducing continuously for a long period of time. And we might be hitting towards a neutrality in December, January if this thing continues. Finally, the SLR cut and the HTM cut, though unexpected lines, but it has an impact on bond yields. And what can happen with this is a long pause, as you said, and with no sight of a rate cut in December at this moment, you could see yields hovering between, they could actually firm up a bit more depending on what kind of inflation numbers we see and international developments.
Okay. Well, let me get to Mr. Sunil Mehta, who has to grapple with competition from the bond market, slightly blunted, you may say. Mr. Mehta, what is your first key takeaway? Are you in a slightly more difficult position because the HTM ratio has been brought down to 19.5? You have to market a larger SLR portfolio, larger government securities portfolio?
Well, the takeaway from the...
Yes.
Yes. Well, the takeaway from the current today's monetary policy committee decision, well, the interest rates are likely to firm up, and the Treasury may not be able to perform as good as they have done in the first 2 quarters of the current financial year. It may have some more strain on making profits from the Treasury front.
What other... yeah, go ahead, sir.
So Treasury front will be definitely a strain from this because and the SLR rate will not affect much in the credit growth because ultimately most of the banks are already surplus in liquidity and they are over-invested than the SLR requirements. So that may not impact any direct bearing on the credit growth. That will basically a function of the new capital formation in the private sector, the demand picking up from the production sector. So that will be the real driving force for credit pickup.
Okay. Well, let me come to other growth impulses and how you see credit growth picking up in a minute, Mr. Mehta. Let me get Sajid into the growth story. Sajid, 6.7%, and it does look like there is going to be no monetary policy succor for growth in the months to come. Do you think 6.7 is realizable?
Well, 6.7 I think is quite realistic, but it would still entail a meaningful acceleration in the second half of the fiscal year. So some of those prints will be helped by this favorable base effect in the second half. Latha, I think the real question and the real dilemma for the central bank is as follows. Normally, when you have such a large growth markdown from 7.3 to 6.7, you should also see a correspondingly large inflation markdown, right? But what you've seen today is a growth markdown, which is realistic, and an inflation markup, which is also realistic. So how do you reconcile weaker activity and higher prices? Well, it comes back to what I was saying earlier, which is this is in a way an implicit acknowledgement of an adverse supply shock, whether it's through higher oil prices, through what the GST has done, or through lingering effects from demonetization. So that is the dilemma the RBI finds itself in, that yes, growth will be lower, but at the same time, inflation in their forecast goes up from 4.2 to 4.6 to 4.9, away from your midline target towards the upper end of your band. And I think that's the dilemma that policymakers ultimately find themselves in. And in a way, that explains the tone and tenor of today's policy statement.
Okay. Now, let me come to the more material point, which, Jayant Sinha was raising. I'm not going to the extreme comments from businessmen who want a 100 basis point cut. I mean, that's really not in the realm of even rational argument. But if you say lower real interest rates, is not that a fair ask at a time when growth is under pressure because of supply side reasons, albeit? Do you really need a 150 basis point real return? Sajid?
Oh, is that to me? Well, Latha, I think the real return needs to be forward-looking, not backward-looking. So if, in fact, these forecasts are right and inflation is going to trend, towards 4.5%, possibly even 5% at some point, and your
his forecasts are 4.6, Sajid. Sajid, his forecasts are 4.6.
Yes.
And even if you looked at the MPR, the Monetary Policy Report, even that in the Q1 of FY19 is still looking at only 4.6.
Yeah.
It's only in the second half that they have a 4.9. But the 1 year forward is only 4.6. So you have to take that the real rate is 150 basis points.
Latha, we've had this discussion before. See, you have one instrument, which is a policy rate. You can't have two simultaneous objectives, which is inflation and a real rate objective, right? The real rate has to be whatever the real rate has to be to keep inflation in that 4.5% to 5% band. So if you were to target a lower real rate, for example, it may well come at the cost of higher inflation. So the RBI needs to be focused very much on where inflation is. If there is an undershooting of inflation, like we saw earlier in the year, then I have no doubt that the MPC may well cut rates later in the year. But currently, if you are forecasting inflation to go from 4.2 to 4.6, then I can understand why there is a little bit of hesitation, particularly because of what's been left unsaid, which is that if you look at the monetary policy review, there is a risk that the MPC feels of 100 basis points slippage in the fiscal deficit, of 1% of GDP. And in their view, at these levels of the deficit, if that risk is realized, then the upside risk to CPI is about 50 basis points. So given all of those factors, I can understand their tone today, but you're exactly right. If inflation were to undershoot, I have no doubt that the space for more easing may open up. But just the essential point again, so people don't get confused, that if you have an inflation target, then your real rate is almost endogenous or subsumed. You have to go after the inflation target, not the real rate target.
Okay. Well, there was a time in the past, previous September, when Michael Patra did lower the real rate to 125 just for one policy. So for argument's sake, it could be lowered. In any case, that's a different topic. Clearly, the Reserve Bank doesn't want to lower it now. Mr. Mehta, let me come to you on that. Do you think that a 6.8 or 6.7% GDP growth is realizable? Given the kind of pressures banks have on lending, unless you get very good capital, is this 6.7% a challenge?
As already said in the Monetary Policy Committee itself, that these data based on which this forecast has been reduced, it's a transitory data, may not be the totally dependable data. So they have to still to work out and firm up these data to make a proper forecast about it. But still, the 6.7% the growth forecast is realizable in my opinion, because ultimately the government is driving to the formation of capital. They are pushing up through public sector investment. The last, I think the media, there's a news was there that they are telling all the public sector units to go for more investment. Then the affordable housing is one growth area which the government is targeting. The infrastructure push the government is targeting will also lead to creation of some...
Can your loan growth improve, Mr. Mehta, unless you got more capital?
Well, so long as, if you say PNB as a general, then we are totally capitalized for the current financial year, and we are growing at a rate higher than what is projected.
Fair enough.
And during the last two quarters. So as a PNB, we are well placed in the growth trajectory of the credit. But if you see industry as a whole, we are doing better than the industry.
Oh, right. Well, we have to take a break on that note, but there is a bigger institutional push that the Reserve Bank is giving, asking banks to move towards industry benchmarks when they set their interest rates. That question to our experts in a minute after this break.